Welcome to The Deep Dive, the show where we cut through the noise, sift through the details, and really bring you the most potent insights from the stack of information we've got. Today, we're diving into a topic that can genuinely make a tangible difference in your financial life. We're talking about powerful tax planning techniques, specifically the art of bunching itemized deductions. Our mission really is to give you a clear, concise shortcut to being truly well informed about optimizing your tax savings. This is, especially valuable for those of you whose itemized deductions typically hover tantalizingly close to that standard deduction threshold. We're here to unlock strategies that can make a real difference to your bottom line. Before we dive deeper, just a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, definitely visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. And special thanks to Professor Farhat for providing this valuable material.
Absolutely. And today, we're exploring a really strategic approach. It's designed to maximize those deductions over a 2-year period, sometimes even longer. It absolutely requires thoughtful planning. You have to think ahead. But the payoff for taxpayers who get a handle on it can be significant.
Okay, let's start with the basics then. Most people know there are sort of two main paths to reducing your taxable income, right? You either take the standard deduction, which is that fixed amount the IRS sets,
Right.
or you itemize, which means listing out specific deductible expenses. Our discussion today kind of builds on the idea that you already have a basic grasp of what itemized deductions are. This strategy really hinges on that.
That's exactly right. This strategy, it really shines, as you said, for taxpayers whose total itemized deductions, when you add them all up, they're just slightly below the standard deduction amount. And here's why. If your itemized deductions are less than the standard, well, you'll just take the standard deduction. It gives you a bigger tax break. Makes sense. The core idea of bunching is to strategically push your itemized deductions above that standard deduction in a specific year. That way you get to claim them and gain that larger benefit, at least for that 1 year.
Okay, so bunching, it means consolidating or maybe grouping together certain deductible expenses into a single tax year. How does that actually impact a 2-year tax strategy? What's the clever part you mentioned?
All right, the clever part is this. By pushing your itemized deductions over the standard deduction in, say, year 1, you claim that larger itemized amount. Good start. Then in the following year, year 2, because you've essentially pulled some expenses forward,
Yeah.
you might find yourself below the itemized threshold again. And that's fine. You just take the standard deduction that year. This timing, this back and forth, it optimizes your total tax savings over the 2 years. It's really about foresight and timing your payments strategically.
Okay, that makes sense. It's looking at it across years, not just one at a time.
Precisely.
To really bring this concept to life, let's maybe walk through an example. Let's use Maria Smith, a 45-year-old single taxpayer.
Okay, yeah, Maria's situation gives us a clear picture. Let's say her state and local taxes, SALT, they're $6,000 annually. And she also has $7,000 in annual interest expense from her home loan. So if we just look at those, her kind of fixed itemized deductions are $13,000, $6,000 plus $7,000. Now, Maria also plans to contribute $2,000 to charity each year. And just for our example, let's assume the standard deduction for a single taxpayer is $13,850 for both this year and next year. Keep it simple.
Right. And charitable contributions seem like a perfect fit for this bunching idea because they're discretionary, aren't they? Maria has control over when and how much she donates. That seems much more flexible than, say, property taxes that have pretty fixed due dates.
Exactly. That flexibility is key. It makes charitable donations an ideal starting point to illustrate this strategy. So Maria basically has 3 main ways she could handle her planned $2,000 annual contribution over a 2-year period. Okay. Option 1 is just the consistent approach. Simple. She contributes $2,000 in year 1 and another $2,000 in year 2. In this case, her itemized deductions would be the $13,000 fixed plus the $2,000 charitable. So $15,000 in year 1. Same thing happens in year 2. $15,000 again. Since $15,000 is more than the $13,850 standard deduction, she just itemizes both years. Over the 2 years, her total deduction is $15,000 plus $15,000, $30,000. Straightforward.
And simple enough? What's option 2?
Now consider option 2, bunching in year 1. Here, Maria decides to make her entire 2-year contribution $4,000 in year 1 and then $0 in year 2. So in year one, her itemized deductions are $13,000 plus that big $4,000 charitable contribution. That totals $17,000. Since $17,000 is well above the standard deduction she itemizes in year one, great. But in year two, her itemized deductions are just the fixed $13,000, no charitable that year. And since $13,000 is below the $13,850 standard deduction.
Yeah. She takes the standard deduction in year two.
Exactly. So her total deduction over the 2 years is $17,000 from year one plus $13,850 from year two. That equals $30,850.
Ah, okay. So that's more than the $30,000 from option one. Interesting. What about option three?
Option three is just the mirror image, bunching in year two. So she contributes $0 in year one and the full $4,000 in year two. In year one, her itemized deductions are just the $13,000 fixed amount that's below the standard.
So standard deduction in year one, $13,850.
Correct. Then in year two, her itemized deductions are $13,000 plus the $4,000 charitable, totaling $17,000. That's above the standard.
So she itemizes in year two $17,000.
Right, and her total deduction over the 2 years is $13,850 plus $17,000, which also equals $30,850.
Okay, so here's where it gets really interesting. On paper, option two and option three look identical, right? They both give Maria an extra $850 deduction over 2 years compared to option one. But there's a crucial insight here, isn't there? Something often overlooked.
Yes, absolutely. It's the time value of money.
Ah, okay, explain that.
Well, think about it. Getting that larger deduction, that's $17,000 in year one, like in option two, that means you get the tax savings sooner. And money you have today is always worth more than the same amount of money you get tomorrow or next year. You can invest it, earn interest, pay down debt, whatever.
Right.
So accelerating your deductions, getting the tax benefit earlier, is almost always financially more beneficial. It's a fundamental finance principle. Option two is better than option three for that reason.
That makes perfect sense. So timing really is key. What else should listeners know about planning charitable contributions strategically? Are there limits or rules we need to be aware of?
Oh, definitely. You raise a very important point. Understand the limitations is crucial. You can't just deduct unlimited amounts. For example, there are adjusted gross income, AGI, limitations. For cash contributions to qualified public charities, you can generally deduct up to 60% of your AGI for the year. If you're donating appreciated capital gain property, think stocks you've held over a year, or real estate, that limit is generally lower, usually 30% of your AGI.
Okay, 60% for cash, 30% for appreciated property. Got it.
Yeah, but there's a nuance there too with the capital gain property. What's often overlooked is that taxpayers actually have an election they can make. You can choose to apply the higher 60% AGI limit even to that appreciated property.
Oh, why wouldn't everyone do that then?
Well, here's the catch. If you make that election, you generally have to reduce the amount of your contribution deduction down to the property's cost basis, what you originally paid for it, instead of its current fair market value. So it might be a strategic choice if, say, the property hasn't appreciated much, or if maximizing the dollar amount of the deduction in that specific year is your absolute top priority. Even if it's technically less than the fair market value, you need to run the numbers.
Wow, okay, that's a fascinating detail. Requires some careful thought. What if someone listening holds stocks that have actually gone down in value? They have unrealized losses. Should they just donate those shares? Seems like a way to get rid of them.
Ah, that's a great question, and it highlights a really critical strategy. If you have stock with an unrealized loss, donating it directly is usually not the best move. It's generally much better to sell that stock first.
Sell it. Why?
Because when you sell it at a loss, you realize a capital loss on your tax return. And capital losses are valuable. They can first offset any capital gains you might have. And if you don't have gains or have excess losses, you can still deduct up to $3,000 of those losses against your regular income each year. Any leftover loss carries forward. So you sell the stock, capture that capital loss benefit. Then you take the cash proceeds from the sale and donate that cash to charity.
Oh, I see.
This way you get the tax benefit of the capital loss and you get the charitable contribution deduction for the cash you donate. It's like a double win for tax planning.
That is a seriously good tip. Maximize both angles. Okay, so that strategy sounds really advantageous. Does this whole bunching idea work for other types of itemized deductions besides charity?
It absolutely does.
Yeah.
Yeah, another common area where people try to apply bunching is with property taxes. The concept is basically the same. You strategically shift the payment of property taxes from one year into another to concentrate the deduction in a single tax year.
How would that work? Like pay next year's taxes early.
More commonly, it's delaying a payment slightly. For instance, say you owe $4,000 in state and local property taxes each year. Maybe your final installment for year one is due right around the end of the year or early January.
Mm.
Instead of paying it in December of year one, you might deliberately wait and pay it on, say, January 1st of year two. Then later in year two, you pay year two's taxes as they come due. The result: in year two, you'll have paid and can potentially deduct both the late year one payment and the regular year two payments, maybe totaling $8,000 in property taxes for that year.
Okay, potentially pushing you over the standard deduction threshold in year two.
Potentially, yes. But
Okay.
there are a couple of really crucial factors to consider here. Huge caveats. First, and this is the big one for many people, the $10,000 state and local tax cap, often called the so-called cap.
Right, I've heard about that.
This federal law limits your total itemized deduction for all state and local taxes, that includes income or sales taxes, plus property taxes, to just $10,000 per household per year, $5,000 if married filing separately. This severely limits how effective bunching property taxes can be, especially if you live in a high-tax state, like New Jersey, New York, California. Many homeowners in those areas easily pay well over $10,000 in property taxes alone, let alone adding state income tax. So even if they bunch $15,000 worth of property tax payments into 1 year.
They can still only deduct $10,000 total for SALT anyway, so the bunching didn't help much, if at all, for the property tax part.
Exactly. The SALT cap really throws cold water on that specific strategy for many taxpayers. It came in with the 2017 tax law changes. You might recall the political discussions around that, aimed partly at higher tax states.
Understood. What's the second factor?
The second factor is more straightforward: potential penalties and interest for late payment. If you're delaying a property tax payment past its due date just to shift it into the next tax year for bunching purposes, you absolutely must figure out if your local tax authority charges penalties or interest for that delay. You have to weigh the potential tax benefit you gain from bunching against the cost of those penalties. You need to calculate the net benefit. Sometimes the penalties might wipe out any tax savings.
Right, that's vital homework to do. Don't want to save on taxes just to pay more in penalties. Okay, so SALT cap and penalties are big hurdles for property tax bunching. What about medical expenses? Can those be bunched? They seem kind of unpredictable.
That's a good point. Many medical expenses are unforeseen emergencies. You can't really plan those. But there are certain significant and elective procedures where you often do have some control over the timing. Think about things like maybe a hip or knee replacement you'll need eventually, or maybe orthodontics for your kids, or even basic eye procedures like LASIK that aren't urgent.
Things you can schedule in advance.
Exactly. The strategy here would be to try and schedule and potentially prepay for these larger costs in a single tax year to consolidate the expenses. Generally, medical expenses are deductible in the year you pay them, even if the service is performed slightly later, like early the next year, prepaying in December for a January procedure, for example.
Okay, so you could potentially combine expenses that might naturally span 2 years into one.
Right. But just like with other deductions, there's a threshold here too, a big one for medical. It's the 7.5% AGI floor. You can only deduct the amount of qualified medical expenses that exceeds 7.5% of your adjusted gross income.
So if my AGI is $100,000, I need more than $7,500 in medical expenses before I can deduct anything.
Precisely. You only deduct the amount above $7,500 in that case. So before you decide to bunch medical expenses, you really need to look at your AGI. Is your AGI likely to be lower this year or next year? A lower AGI makes it easier to surpass that 7.5% floor. So you'd want to bunch the expenses into the year where you anticipate having the lower AGI to maximize your chances of clearing that hurdle and getting a meaningful deduction. It requires looking at the whole picture.
This has been incredibly insightful. Okay, let's try to summarize. The core benefit of this bunching strategy, it seems, is it's a powerful way to optimize tax savings over, say, a 2-year window. It lets you get over that standard deduction hurdle in certain years by strategically timing payments, instead of just maybe falling short every year and taking the standard deduction by default. But it's definitely clear it requires some careful planning and knowing the rules.
Absolutely. Understanding these rules, the limitations like AGI floors, the SALT cap, the time value of money, it's all critical for this to work effectively. This strategy isn't about finding loopholes, not at all. It's about being proactive, looking at your broader financial picture, and making informed, legitimate decisions to manage your tax burden effectively over time. It's about understanding why these rules matter to your bottom line.
What an illuminating deep dive. Okay, as we wrap up, here's maybe a final thought for you, the listener, to consider. Think about your own recurring expenses. Are any of them discretionary, like charitable giving? or perhaps prepayable, like certain elective medical procedures, how might strategically shifting the timing of those payments impact your tax liability over the next couple of years? It really encourages you to think a bit more like a tax planner for your own finances.
Yeah, that raises the important question. How can you apply these principles? Maybe not all of them fit, but perhaps one or two could work for your situation, or maybe help you advise others more effectively. It's about applying the knowledge.
Exactly. And if you want to explore these concepts further, maybe work through some more examples, get practice with multiple choice questions, or watch detailed video lectures, especially if you're studying for the CPA exam or another professional certification, definitely head over to farhatlectures.com. You'll find a wealth of resources there to really solidify everything we've talked about today, from the basics of itemized deductions right through to these clever bunching strategies. And again, a special thanks to Professor Farhat for providing such valuable material for our discussion. That's all for this deep dive. Thanks so much for joining us, and we'll catch you on the next one.